Hello everyone, good to see you in this beautiful venue and city. So obviously we all know USD stablecoins. They're about like 99% of the market, even more. But today we want to shed a light on all non-USD stablecoins and kind of why institutions are looking into them as well, what the barriers are for regarding adoption and what we can expect for the kind of next years, because obviously with regulation in Europe, things will probably change now that institutions are getting involved big time. So with our guests, we would like to discuss these topics, and I would love for every one of you to introduce yourself quickly, please.
So I will start. Hello everyone, I'm Sylvain, I'm CPO of SG Forge, and mainly we are a stablecoin issuer for Euro and Dollar, and we try to push the Euro as far as possible, so good discussion.
Hi, I'm Peter. I'm CTO at AllUnity. We're building a multi-currency, multi-chain stablecoin platform, which means that we already launched a Euro-denominated stablecoin, the Swiss franc-denominated stablecoin, and we really believe into the future, of non-USD stablecoins, and that's why we build our platform.
Yeah, hi. Good morning, everyone. My name is Johannes. I'm the managing director of the Frankencoin Association. We're the steward of Frankencoin. Frankencoin is a fully decentralized Swiss franc stablecoin. It's the largest in the market. And we're kind of the Swiss guys, right? Always talking about store of value instead of transactions. But that's going to be an interesting conversation with you as well after, I guess.
Hi, I'm Sylve. I'm the co-founder of Hyli. We're a Layer 1 blockchain optimized for CK-based applications and specifically everything related to confidentiality.
Great. I'll have some questions for you today, and obviously feel free to chime in anytime. Some questions are for all of you, and some are just kind of individually, but we can just talk about it casually. So my first question would actually be to all of you, and it would be, when institutions are actually looking at non-USD stablecoins today, what in your view is the most realistic use case that they're actually kind of thinking about when they kind of want to learn more about them? Whoever wants to go first.
I start. So on our side, when we speak with a non-USD stablecoin and use case, we have one use case with demand for now is for, let's say, institutional entity that is European based. When you do your accounting report in Euro, and when your reality is in Euro, you need to have the stablecoin, Euro stablecoin for that purpose. But it's crypto native entity, and behind this crypto native entity is more, let's say, high net worth individual, SME, small asset manager. And in terms of, let's say, in the forward use case, the more advanced discussion is with corporate, and mainly for payment and cross-border payment and treasury management. And the last point that is quite interesting is about discussion we have with traditional market infrastructure, exchanges, clearing members, and custodian. That is the main, and it's more for collateral management and settlement for securities on chain.
I go next. So I think the first question is, and so I heard it a lot when I told people that we're building a Euro-denominated stablecoin, especially people in crypto usually tended to react like, why do we need that? Yeah, so because we have this US dollar dominance, 99% or even more of stablecoins used in crypto are US dollar denominated stablecoins, and I think, and that's the response to the question as well, because I think that non-USD stablecoins really can't copy the history of stablecoins, so kind of becoming like strong in the crypto space. I think especially the non-USD stablecoins need to play an important role in the real world and in real world use cases, because in the end, so where's the relevance for different currencies, so like Swiss franc or Euro or Hong Kong dollar and so on, of course in the real economy, because if people want to receive salaries, if businesses want to pay, in the end they do this in their local currency, and we see more and more adoption in the real world. Also thanks to Stripe, for example, integrating it into their products, and banks being interested in using stablecoins and other distribution platforms. Stablecoins being integrated into fintech systems as well, and therefore I really believe that the usage for non-USD stablecoins will mostly be in the real world.
I agree and disagree with you here, Peter, because I think you're kind of interesting with the the Swiss franc and the euro, and those two cannot be compared. I'd argue here. With the euro, I would agree fully with you. It's it's transactions, it's real applications, payments, But for the Swiss franc, as a special case, is a bit different because it's more a store. I've said that before. I'm going to say it a couple of times probably today again. The store of value thing, which has its place also, not just in the real world, obviously. Agreed that we need to go towards real world applications and what we see, but also for crypto native users that want to move into a less volatile asset, which is not losing value as the dollar does. And that's where probably, and argue with me if there's other currencies that have those properties. The Swiss franc is kind of this, it's not digital gold, it's just like the less volatile store of value you have on-chain, and which also crypto natives can use. And we see institutions being quite interested in that, that to get back to your question here, what institutions see, but then liquidity becomes a big bottleneck, which probably is more one for us than for you guys, because we cannot just go and mint new Swiss francs or Frankencoin with fiat, because it's decentralized. So that's like where we're building.
Perfect. Yeah. Sylve, no comment here. Peter, then
I could make a comment. Just wait if you wanted to say something. That's you raised an interesting point, because I think we really need to look into like every currency and kind of like judge. So what's the real usage for it? Because I agree, like Swiss franc really plays an important treasury function. I think even with euro, because you said it's for transactions, that's true. But also when looking into Europe as a whole, we have the euro system with SEPA Instant and so on. So like the infrastructure is pretty far developed. So it's also a little bit a question how many transactions are done in euro stablecoins within Europe. Yeah, so that's maybe also there other people in the round have an opinion to that, but. So especially from the global perspective, when we have stablecoins in different currencies, we leverage that use case of global remittance and FX, and I think that's where it really becomes interesting, especially on the transaction side.
Yeah. And Peter, on that note of institutional use cases, for institutions that are already managing multiple currencies, generally speaking, is there something where non-USD stablecoins can actually kind of improve the workflow also for them compared to the kind of traditional banking rails that they're using today?
Yeah, so in general, stablecoins can be used in 4 verticals, how I always say it. So it's in payments, it's in remittance, so if you send money around the globe. It's in settlement, if you settle, for example, crypto assets or real-world assets. And it's in treasury, so you hold it and you want to earn yield. And I think coming to the institutions, I think we need to judge how, like in what vertical they are and where they're located, because like I said, for example, for European banks doing transactions from within Europe, I think I suppose that every bank would prefer doing transactions within Europe with the SEPA system, because that's the easiest for them and probably also the cheapest. So I think that's not really the use case. But in global remittance and in FX, I think it's incredible help to use stablecoins as a platform, also for integrating the technology into fintech products and so on. I think it's way more easy than using banking as a service or other companies and platforms of that kind. And then also, I think that has always been the end game, I think, also for people working in blockchain when it comes to settlement, because of course it's the holy grail that we maybe can achieve in the end, that you have tokenized assets, tokenized real-world assets from all across the globe, and you can settle them instantly on-chain. I think that would also be an incredible future for banks doing those kind of businesses.
Great, and Sylve, from kind of a payments infrastructure perspective, where are non-USD stablecoins kind of simplifying cross-border settlement today, would you say?
Well, in the context of the euro, there's actually, I would say, a massive bootstrapping issue compared to the US dollar, which is that no one wants this for remittances. It's extremely useful within the Eurozone, but like we pay people in stablecoins, in dollars, in the Philippines or elsewhere, but they do not want euros. So that's one less use case that we can have in order to bootstrap just liquidity for euro in general. And then you mentioned settlement, and that's actually another tension that we have in the Eurozone, which is, on the one hand, we want to move really fast with what the ECB considers commercial money, but like euro stable coins, but at the same time, they're moving forward with their own version of the euro stable coin, they're moving forward with Appia, they're moving forward with their digital euro. So it's moving a little bit in all different directions. And as for payments, like currently it sort of works, but it's completely lackluster when you compare it to like the residual demand that exists for dollar stable coins.
And Johannes, when we look a bit more on-chain, obviously crypto markets are very USD centric. And what role would you say play non-USD stablecoins within DeFi and on-chain in general today?
Yeah, I mean, I always make this point for this differentiation between an asset and a means of transaction, right? Because if you do a transaction, you don't really want to hold that asset. And that's where the dollar makes a lot of sense, because then you want to have just the most liquid market you can get, with the lowest slippage, with the lowest fees, with the easiest on and off ramps. So where I see non-dollar stablecoins in DeFi is as an asset, meaning you want to use a certain product, you want to go short something, you want to leverage something, you want to build a basket. You know, the good example with the Frankencoin is SACX Edelweiss, which is a DTF, which is kind of a, I think it's positioned as a ETH plus, which is less volatile and better, right? And that's where non-dollar stablecoins can play a very strong role, depending on who you are and what you want to do, right? Obviously, from my perspective, the Swiss franc is the obvious choice for like Globe for everyone because it's stable. But there's certain people who might want to have a short exposure to the euro because they are doing trading there, or they might want to leverage the euro, or they have business which are off-chain in whatever market and want to hedge against their local currency. You know, there's many options and things where you can use that now. That said, I think as a settlement currency, it's hard to compete with the dollar. And anyone issuing a non-dollar stablecoin, I would kind of suggest try not to compete with the dollar on settlements. You're gonna die just because of the liquidity the dollar has. But there's other things, and those are, I'd argue, to be found more in DeFi than in the centralized or CDeFi, as you would call it, right? Because in DeFi you can only use stablecoins. They are often more efficient because they have immediate settlement. You don't have counterparty risk, rather than having those same products in the decentralized world. Or they might not even be accessible because not the whole world has the same access to financial services as we do in Central Europe, and they might also need or want this.
Yeah, and also stablecoins have always been the safe haven in fast markets, right? So if kind of the prices go down, so to just like go out and wait. And also what we shouldn't forget, especially also with the politics that the Americans are doing these days, there's a huge devaluation of the dollar. Yeah, so if you hold dollar, whatever, you got it 1 year ago, so you lost quite some money in parity towards the euro, for example, and that might also be the case in the future that so if people want to get out in fast markets, so that they better use a Swiss franc, euro, or another stable currency.
And that gets actually interesting because right now it goes the other way around. There's now many people thinking because you still have the petrodollar, that the dollar might appreciate, even though the Trump administration is kind of printing hard. And that's why, for example, there was a discussion in our community going on not too long ago with Liquidity, where you can use Liquidity, and it's actually been proposed, I think, yesterday. It's not live, but it's going to live next week if no one vetoes it. But you can now leverage your Swiss franc, leverage your dollar or Liquidity dollar with a yielding Liquidity dollar against the Swiss franc. So it goes both ways, right? You go short Swiss franc, there's a need for that, there is a demand for that. And I think this is the same with any currency, and that's where it makes a lot of sense to have those currencies if they are liquid enough.
Yeah, thanks for this great overview on kind of institutional use cases. I want to talk a bit about the adoption constraints, what's kind of holding growth back a bit, and a question to all of you. I mean, as we mentioned today as well, or you mentioned today, liquidity is obviously a huge aspect here, and it's kind of the biggest barrier for some institutions at least to engage. And without liquidity, institutions also can't really rely on these markets, so it's kind of this chicken and egg problem. And I would be curious, how do you see this liquidity barrier, liquidity issue solved?
That's a good question. Liquidity, to be honest, is a nightmare for a stablecoin issuer. It's really expensive, it's costly, and there is a lot of constraints. So I would say liquidity and accessibility is the key element for a stablecoin issuer. On our side, I think there is not only one good answer, but on our side, the strategy was to try to be, let's say, crypto native compatible, but also TradFi in parallel. So we push the same strategies and, for example, Circle or Tether for Euro. I mean to increase the network and to increase the distribution. We consider centralized exchange, we consider broker, crypto broker, and also protocol like within this network. So we push this use case. It could be trading, margin call, margin loan, but also lending, borrowing, on DeFi. But it's not enough, and it's really expensive. So we need in parallel to have some usage and some use case. That's why we push for institutional use case in parallel. We want to leverage on let's say on what asset we have within Societe Generale. So we push for institutional use case with our client for payment. We discuss with market infrastructure to enable Euro stablecoin within their legacy system. We try also to allow securities on chain to ensure there is economic activity within this ecosystem, because without it you don't need a stablecoin. So we try to do it in parallel, but it's a kind of race because everything is difficult. You have compliance constraints and you have a liquidity cost that is not so obvious. Every time you onboard a market maker, it's a cost of capital for the bank, so it's not so. It's really a charge. So we need to be careful, and we need to onboard, let's say, partnership that is relevant.
I think I would answer that question around adoption again from the perspective of the theory that non-USD stablecoins really need to happen in the real world. And I think, so when looking at the crypto world, I think adoption is mostly driven by paying incentives, right? So if you do like launch campaigns and you pay incentives, and then you usually are able to gain TVL. In the real world, it's a little bit different. And from my perspective, the distribution topic will really be the driving factor for adoption of non-USD stablecoins, which in the end means, so once the Revoluts, the Stripes, and Amazons, SAP, and so on in this world are adopting stablecoins, then via this distribution, the non-USD stablecoins can also grow.
That's certainly one point, like real adoption. Keep in mind, one problem you have with liquidity on chain, now I'm talking about decentralized markets, you know, Uniswap, AMMs, and so on, is that they're extremely capital heavy. You have dead capital, which is basically parked on fragmented markets. You know, you have to have it on every chain. You're basically launching something. And that is super inefficient from a capital perspective because you have, in our case, worse than in your case, because we have to mint it. You have capital costs. There is engineering solutions to that. There's a lot of research and building going on with intent-based stuff, on-chain OTC deals, RFPs, basically unified liquidity across chains, and so on. So I think this problem, in absolute terms, at least for us, for a decentralized stablecoin, will become smaller over time a bit. But apart from that, as you said, usage, people wanting to buy it, but also people willing to buy it. Venues, liquidity comes with venues. Where can you obtain that stablecoin? And if you can't buy it anywhere, you will not have any liquidity. And unfortunately, especially centralized exchanges, most of them their business models are still geared very much towards highly volatile tokens. And that is reflected in fees. And that is reflected in, like their onboarding processes as well, that they're built for meme coins and not for stable coins. Just an example, one on-ramp which we were working with and we stopped working with them, bottom line, they charged 7%. And, that might work for a highly volatile meme coin, but you can't charge 7% on the stable coin, and then someone has to foot that bill because they're arguing, yeah, this is compliance cost and this is like our card cost we have. And that just kind of, you need to build new venues for that, I argue. And I believe just, the very big players, Circle, Tether, is just being subsidized heavily so that they have those cheap on-ramps as they have right now.
Just to jump into what you said, Johannes, you're right, but the main point on my side is when we speak with, for example, this big traditional market infrastructure, and when they consider stablecoin within their legacy system, for example, collateral management and so on, the first question they ask is how we can modelize the stablecoin with their risk framework. What will be the LTV? Do we consider that stablecoin, our euro stablecoin, so SG4 stablecoin, is it like a corporate from Societe Generale? No, it's a kind of question we have. And one point that is quite important, they point out the liquidity, because with this liquidity is not efficient today, but it is a proxy to the adoption. So if your stablecoin is considered as liquid, and the metrics they have of liquidity comes from, it's not efficient, but come from centralized exchange, come from Uniswap or Curve swap, and so they calculate the spread, they calculate the slippage and so on, and after they will consider it as a liquid asset. And from my side, the main point, that's why I say it's a race, is we want euro stablecoin to be considered not as an asset, but like a fiat. You know what I mean? That I mean it's not a product, it's an infrastructure per se. And this is the main point. That's why I think there is a race for euro, because for dollar, I think it's quite difficult. But for euro, there is room, and we need to have an equivalent of Tether or Circle in euro to integrate this kind of market infrastructure. And when they speak about dollar, they don't consider as a regulated one or, let's say, a bank dollar one. They consider as the most liquid. They consider Circle. They consider sometimes Tether when they will be regulated. So the race of dollar, it's, let's say, win, and we need to have it for euro. So that's why it's quite this question of liquidity, because it's accessibility, but you cannot onboard all the world. So you need to have liquidity on chain. You need to have a secondary market to ensure it is accessible by let's say, the world. And this liquidity is really a key point, and it's not so obvious.
Sylve, anything you wanna add here on liquidity?
Well, one big question here will be what the regulation looks like, and in particular, what happens with like central bank euro in regards to commercial money, because that's basically the big cheese. Like everything we do is to put tokenized assets on chain. The thing is that there's a very heavy book of regulation regarding delivery and settlement, and the moment you start realizing or you agree from a regulatory standpoint that, yep, commercial money actually is equivalent to ECB money, you can just do settlement on chain and all hell breaks loose. And it is very, very, very unclear that the ECB or the regulation wants to move there. But at the same time, it allows the Eurozone to experiment quicker. So it's a really big thing. Either the guys at the ECB move fast enough that we can actually get central bank money on different chains if they manage to publish something faster than a report every 3 years, or you'll have to have a circle.
The question back to you, it's a political one, right? Do they want to experiment faster?
No.
Exactly. I mean, that's what we see in Switzerland as well. The FINMA and Lucius, the inventor, said it very nicely in an interview 2 weeks ago. First priority, stability. Second priority, stability. And third priority, stability. Right? That's how the FINMA, the Swiss financial regulator, thinks. They don't want experiments.
I think history tells us about like something that happened already. I mean, Sylvain, you probably know this better than I do, but I read a really, really heavy book on the history of infrastructure and settlement systems in Europe. And basically you had CSD, clearing houses, everything else. And then like mid-2000s, we said, oh yeah, we're actually going to have a central thing called T2S that's going to centralize everything, and it's going to be easier. I guess we're going to have the exact same thing. Like, people will be able to like marginally innovate on the fringes just to move right enough to build something like Circle-like, and then the ECB gets their shit together and say, oh, actually, we may have something that works now, and you guys can actually have digital euro that works.
And then, Sylve, I have another question for you. Which key technology enablers would you say are still missing today for institutions to actually adopt and really kind of scale non-USD stablecoins?
I mean, you always have the three usual suspects, like performance, compliance, and confidentiality. On these three aspects, it's still very lackluster, and we're all vibe coding solutions together and trying to make it work, which is why I believe that there's like still significant innovation that could happen at the euro level. Just trying new stuff. Like you can try using zero-knowledge technology in order to make compliance faster. You could leverage EITA signatures. You could leverage the fact that every single European citizen has a digital signed ID card that could be used for KYC, or even just to wire money. But again, it's a political question. Very difficult to answer.
I actually really want to highlight the one point that you mentioned, confidentiality. I think that's the most underrated but most important topic, I think, to really drive real-world adoption. Because I think, like us in crypto, so we kind of dealt with that in the past, so that we know, like, okay, so we somehow the transactions are transparent, so we can deal with that. But if a large corporation is like Siemens also is going to use stablecoins for payments, kind of without confidentiality, it would be a no-go for them. So therefore, it's great to see so many initiatives these days really trying to solve that.
And I think there's a really big tension here between, and I'm curious what you think about this, Sylvain, for example, which is like the playbook for stablecoins is let's try and pick up the slack and get to the level where the US stablecoins are. But it seemed from the discussion that we're much more on institutional use cases than the usual payments or remittances use cases, where in our case, confidentiality would be much more of a pressing issue. But the thing is, in order to bootstrap liquidity and everything else, you have to play ball. You have to be in the curves, you have to have liquidity, you have to have LTV, which basically goes against developing or bootstrapping confidentiality features. So I'm just curious, like, what we do to get there.
Why not both?
Well,
piggyback on top. You build it without confidentiality, build it up, and then we're having those conversations, for example, where you then piggyback on top of it, and you have a part, or you enable also confidential transactions on top of your stablecoin. Sama, for example, offers that, right?
It was a very different discussion that we had, talking with different Euro stablecoin issuers. With like, yeah, confidentiality, this is fantastic, this is perfect. This is in 15 years. When we actually are out of the dead zone and we make sure that we have enough LTV that we don't look like idiots compared to US stablecoins. So it's definitely like the 5th or 6th priority.
I can't argue with that.
And Johannes, obviously, decentralized stablecoins have different approaches in many ways than bank-issued models. And my question to you would be, for institutions, does that bring certain advantages or also trade-offs? What would be like just the main few points?
I mean, one very big advantage is that we're unencumbered with many of the very restrictive regulations which make life hard for centralized stablecoins. For example, DeFi composability, yield on top of it. And that obviously there's a lot of institutions that basically, they want to use centralized stablecoins because they have this regulatory clarity and especially the path to liquidity. That's always the big point, right? How can you get from my stablecoin back into fiat if I need to? But then they're actually, from a use perspective, they're a lot more interested in decentralized models because then they have the whole DeFi world at their fingertips and they can, potentially start giving yield to their clients with it, or they can use it so that their clients can use their assets and borrow against it, which is also a lot harder doing with a centralized stablecoin. So I think DeFi composability is the big advantage, which, just because centralized stablecoins, because of the regulation, are not allowed to do it, it's a play field where, and a decentralized stablecoins in that sense, it's nothing else. How does a protocol like Frankencoin differ from a protocol like Aave or Morpho? It's a lending market. It's just the difference is that it's a lending market which is a one-sided lending market, because the other side is just a fixed, Swiss franc representing the value of the Swiss franc. So it's DeFi playfield. Composability.
And Peter and Sylvain, when obviously with regulation now emerging in Europe and obviously being active for getting close to 1.5 years now, I would be curious, would you say this also had like some barriers along with it for certain institutions, or is this just really the kickstart for making this all possible, or do you see some barriers with regulation in general?
Well, I think so. From the crypto perspective, I think regulation is always making things more difficult. From the real world perspective, regulation opens doors for adoption.
Yeah, well, so regulation. We are in Europe, so regulation is it's really painful, a little bit difficult. I think at the end there will be 1 or 2 or 3 euro stablecoin, but with bank, maybe crypto native entities that is regulated also. But the main point today is the prohibition of interest of this kind of, this feature is really concerning. I think it's the same for US now, so we are in the same level now, so it's quite good for that. And that's why DeFi is pushed a lot, because it is maybe the only gray area that allow a stablecoin issuer to distribute yield. So, but we need to have a clear message from the regulator on that point.
Yeah. Well then, one last closing question to all of you, maybe 1 or 2 sentences answers, please. So when we're really talking about the future of non-USD stablecoins and scaling this institutional adoption, I want to ask you, if we have this conversation again in 5 years, maybe, or 2030, we're sitting here again, what would have need to happen for institutions to really widely adopt non-USD stablecoins? What's like the main thing, simply put, for you?
A third Donald Trump term.
Good one. Lindy. I mean, maybe the old guys getting how you call it, going into their pension, and the new generation understanding the risks and actually having them in.
From the infrastructure side, confidentiality as a door opener, and other than that, really distribution so that large platforms adopt stablecoins.
So non-USD securities on chain. It will allow to have this kind of economy. And yes, that's it.
Perfect, yeah. I love that we now went from the other direction for the last question. That's perfect. And I can close with a thank you very much and have a great rest of the conference.